All right, picture this. It's late 2025. The market's hitting all-time highs, which feels great, but the signals, they're getting pretty scrambled. So how do you make a smart move when the data's pointing in every direction at once? This isn't about having a crystal ball, it's about having a system to cut through all that noise. Okay, let's dive right in. We start with a portfolio that's really built for speed. Its beta is 1.36. Now, all that means is it's designed to be about 36% more volatile than the market. When things are going up, it's supposed to go up even faster. But when the market turns, well, you get the picture. It's a high-octane, aggressive position. And that really brings us to the central question here. With the market hitting these incredible highs, but with some pretty troubling signs just bubbling under the surface, is sticking with this aggressive stance a sign of bravery? Or is it maybe just a little bit foolish? So first up, let's talk about the immediate challenge, what we'll call the end-of-year dilemma. We are right in the middle of the holiday trading period, and this isn't just any couple of weeks. Trading volume absolutely plummets, which can create these really fragile, kind of unreliable market moves where false signals are everywhere. So, what's the first major clue in this whole puzzle? It's the incredibly conflicting story the economy itself is telling us. It's like trying to listen to two completely different songs playing at the exact same time. Now this is where it gets really interesting because the conflict in the data is just so deep. On one hand, you've got strong GDP growth and super bullish sentiment, which says, hey, everything's great. But then you look over here and you've got a weakening labor market. And then there's the VIX, what they call the market's fear gauge. It's really low right now, which kind of suggests investors might be getting a little too complacent, maybe ignoring some of the risks. And this slide just perfectly illustrates that dilemma. I mean, how can an economy be firing on all cylinders with 4.3% GDP growth, while at the very same time unemployment is ticking up? This points to an economy that's growing without creating new jobs. And historically, that's a classic warning sign that a recession could be just around the corner. Okay, so if the economic picture is a total blur, maybe the technical story, the story the charts are telling us, can give us some clarity. Do they support the bullish case or the bearish one? Now, to really understand what the charts are saying, we need to use a tool. A key one is the RSI, or Relative Strength Index. The easiest way to think about it is like the market's speedometer. It tells us how fast prices are moving, and more importantly, whether that momentum is speeding up, slowing down, or maybe even about to slam on the brakes. Let's start by zooming all the way out to the big picture. On a long-term monthly chart, the trend is undeniably bullish. The RSI is way up over 70, which is a clear sign of a strong, healthy bull market. From this view, holding that aggressive, high-beta portfolio makes a lot of sense. But watch what happens when we zoom in just a little bit to the weekly chart. The picture starts to change. Yeah, the trend is still positive, but you can see that bullish momentum is really starting to run out of steam. The RSI is flattening out, suggesting the market is taking a much-needed breather. And then we zoom into the daily chart, and the picture gets even weaker. Sure, there's been a little bounce, but the underlying momentum is still negative. So the charts are basically telling us three different things at once. Long-term is strong, medium-term is slowing, and short-term is weak. The signals are completely at odds with each other. This brings us to the final and, maybe the most important piece of the investigation, value. Even if the trend were perfectly clear, is the market's price tag just way too high? We can measure this with something called the price-to-earnings ratio. Right now, for the big tech stocks in the NASDAQ 100, it stands at a very high 34.15. In simple terms, that means for every $1 of profit these companies make, investors are willing to pay over $34 for a piece of that company. That's a pretty steep price. And this chart really puts that number into perspective. The current valuation isn't just a little above its recent average. No, it is a staggering 40% above its long-term historical median. This suggests the market is priced for absolute perfection, leaving very, very little room for error if any of those warning signs actually turn into something real. So the crucial point is this, and one analysis puts it perfectly. This is not a time for chasing more gains. The high price tag means it's a time for caution, a time to protect your capital and build up your options for when better opportunities eventually come along. So after weighing all the evidence, that split personality economy, the conflicting charts, and the very, very expensive valuation, the sources all converge on a single unanimous conclusion. The verdict is clear. It's unambiguous. It's time to reduce risk. The potential reward of staying aggressive is just no longer worth the significant risk of a market downturn. It's as simple as that. And here's what that actually looks like in practice. It's a disciplined, three-step rebalancing plan. First, sell the most volatile things, especially any leveraged assets. Stuff bought with borrowed money. They're great on the way up, but they can absolutely crush you on the way down. Second, build up your cash reserves. And third, bring the portfolio's overall beta down from that aggressive 1.36 to a much more moderate 1.15. But, and this is so important, this isn't a one-time set-it-and-forget-it decision. It's a forward-looking strategy with key checkpoints over the next 6 months. It sets specific dates to reevaluate all the data, from inflation reports to company earnings, and potentially add risk back, but only if the evidence confirms it's the right move. And this really gets us to the core principle of the entire strategy. It isn't about trying to predict the future. It's about having a plan to navigate uncertainty. And it's perfectly summarized by this simple but incredibly powerful rule. You de-risk based on a set schedule, but you only re-risk when the data gives you a clear green light. So the real question isn't whether the market will go up or down. It's this. When you're faced with all this uncertainty, are you going to be guided by hope, or are you going to be guided by a plan? In the long run, which one do you think really wins?